All right, let's dig into a really fascinating corner of the market, silver mining stocks. You'll often hear them called a leveraged play on the metal itself. But what does that actually mean? Well, it's a concept that promises some absolutely explosive returns. But as you'll see, it also carries some pretty serious risks.
So let's just start with a puzzle. How on earth can a relatively small 20% bump in the price of silver create a gigantic 100% explosion in a company's profit? I mean, that math seems impossible, right? But this isn't some kind of trick question. It's the very heart of why these stocks get so much attention.
And the answer, the secret sauce, is a concept called operational leverage. The best way to think about it is like a real lever, one that can amplify a small push into a huge result. But just like any powerful tool, you've got to handle it with care. It is a true double-edged sword, one that can deliver incredible gains, but also inflict some really deep cuts.
Okay, so let's dive into the first edge of that sword, the really exciting side, the one that gets everyone's attention. This is where the magic happens.
The key to understanding all of this comes down to one single number, the all-in sustaining cost, or what insiders call AISC. This is, pretty simply, the company's break-even price. It's what it costs them to do absolutely everything. Dig the silver out of the ground, process it, pay all their people, keep the lights on, all just to produce one single ounce. This number is the fixed hurdle they have to clear before they make a dime. Let's just walk through the math here. It makes it super clear. So imagine our miner's cost, their AISC, is fixed right there at $40 an ounce. Now, if silver is trading at $50, they make a nice, respectable $10 profit on every single ounce. But here's the kicker. Watch what happens when the price of silver just nudges up 20% to $60. Their cost? That's still $40, but their profit per ounce has just doubled to $20.
And this chart just visualizes that jump perfectly. I mean, look at the difference. That small bar on the left is the 20% move in the silver price. And that giant bar on the right, that's the 100% explosion in the miner's profitability. The market often sees this coming and bids up the stock price way more than just the 20% gain in silver. That, right there, is operational leverage in action. But, and this is a big but, remember what we called it, a double-edged sword. Leverage cuts both ways. So now, it's time to look at that other, much sharper edge, the one that cuts back, hard, when prices fall. And this slide just illustrates that danger perfectly. Let's flip the scenario. Say the price of silver falls 25%, dropping from $60 down to $45. Now look what happens to the miner's profit. It completely collapses, from $20 an ounce all the way down to just $5. That's a brutal 75% plunge. The exact same force that amplifies gains on the way up absolutely crushes them on the way down.
And you know what? It's not just the silver price you have to worry about. In the real world, there are all these other headwinds constantly blowing. The cost of fuel, labor, all that heavy machinery, those things can rise and just eat away at that profit margin. Plus, these mines are physical places. They can't just flip a switch and suddenly double production when prices are high. And a lot of these companies, especially the smaller ones, have to issue new shares to raise money, which can dilute the value for everyone who already owns a piece of the company.
So, let's take all this theory and apply it to the real world, because this is where things get a lot more complex. And probably the most crucial detail you need to understand is this. Not all companies that dig up silver are actually silver companies. And here's the wild statistic that just changes everything. A staggering 70 to 80% of all the silver mined in the entire world doesn't even come from a silver mine. It's a byproduct. It's just the stuff that comes out of the ground when companies are actually mining for other metals like copper or lead or zinc.
So this creates a really critical distinction. On one side, you've got your primary silver miners. These are the companies that offer that pure, hypersensitive leverage we've been talking about. And you can usually spot them by checking their financial reports to see if silver makes up most of their revenue. But on the other side, you have these massive byproduct producers. I mean, they might produce millions of ounces of silver, but it's just a tiny fraction of their overall business. Their stock price is going to be driven by what gold or copper is doing, and it has almost zero leverage to the price of silver.
All of this complexity can lead to a really bizarre and counterintuitive situation. Believe it or not, there are actually times when silver stocks do worse than the metal itself, even when silver's price is going up. This weird phenomenon is known as negative leverage.
So what causes something like that? Well, there are a couple of key reasons. First is something called jurisdictional risk. A mine is a physical asset, right? It's stuck in the ground. You can't just move it if a foreign government suddenly decides to hike up taxes or change the rules. Just the threat of that can make investors nervous, causing the stock to lag behind the metal. And second, simple market sentiment plays a huge role. When prices are swinging wildly, investors might just sit on the sidelines and wait to see if the higher prices are going to stick around before they're willing to bid up the stocks.
So, look, the crucial point to take away from all this is simple. Operational leverage is an incredibly powerful force. It's what gives these silver stocks their explosive potential. But it is absolutely not a one-way street. It is both a profit amplifier on the way up and a massive risk multiplier on the way down.
Which brings us to the final question, the one you really have to ask yourself. Because, understanding the theory is one thing, but actually living through that kind of volatility is something else entirely. So knowing everything we've just covered, are you truly prepared to handle both edges of that sword?